Hi, I'm Matthew Lumsden, Head of Distribution at Vanguard Australia. I'm joined today by Mike Roach and Janel Jackson from our Quantitative Equity Group, Vanguard's in-house active equity manager, which has been managing active assets since 1991. Earlier this year, we launched our first active funds into the Australian market. Today, we will discuss the Global Minimum Volatility Fund. Thank you both for your time. Before we start, could you just introduce yourselves? Maybe Mike, we start with you.
Sure. Well, I'm a portfolio manager here in Vanguard's Quantitative Equity Group, and I'm responsible for the team that manages Vanguard's quantitative strategies here in Australia, which include our factor-based funds. I've been with the Vanguard Group for over 19 years. I recently moved here with my family to the Australian office in Melbourne, and we're really enjoying our time here.
I work with Mike in the Quantitative Equity Group, and I've been with Vanguard for the past 5 years. I've been in the investment management industry for over 13 years and spent most of my time in manager due diligence roles. So I appreciate the information that our clients need to understand our investment process and to be certain that we're doing our jobs well. I've been enjoying my time in Melbourne, mostly the diverse culture and amazing coffee.
Before we talk specifically about the fund, Janel, it would be great if you could start by telling us, is minimum volatility a factor?
Of course. So in a broad sense, you could call it a factor, but the way we approach minimum volatility at Vanguard is to use a range of factors. We don't just target low volatility stocks, but also incorporate the interaction amongst those stocks to increase diversification. We do this with the aim of minimizing portfolio volatility. In contrast, low volatility funds are factor funds, where only a stock's volatility is measured before the manager decides whether to include that stock in the portfolio.
Thanks, Janel. Mike, it'd be great if you could explain our approach to minimum volatility.
Well, minimum volatility strategy aims to reduce the volatility of an equity portfolio compared to the global equity market, while still looking to produce long-term capital growth. When constructing a minimum volatility fund, it's important to look both at the volatility profile of individual stocks, but also at how correlated those stocks are to one another. Strategies that focus on only one dimension, like individual stock volatility, can end up producing large unattended bets like sector biases. And given that our objective is to control risk, we find it more beneficial to use a minimum volatility framework where we can apply a set of reasonable constraints that foster diversification, but also help mitigate the over-reliance to any one exposure, like country, sector, or style.
With that in mind, what is the primary benefit of this fund to the end investor?
Investors may want to reduce their volatility exposure, but for various reasons may not want to move out of equities. Now, historically, an investor would attempt to do this by purchasing a fund with a perceived defensive nature, such as a high dividend yield. And while products like these can be great tools for investors, any reduction in volatility is only a byproduct and can be really market cycle dependent. A minimum volatility fund explicitly is designed to match an objective of lower volatility. It may help if I use an example to highlight what the fund is designed to achieve. So if the market were to drop by 50%, it then takes a return of 100% for the market to get back to where it was. So in a market downturn, a minimum volatility strategy seeks to reduce the amount that a fund would need to return just to get back to where it started. In other words, it's designed to reduce the impact of a market fall.
Financial theory tells us that markets eventually reward higher risk with higher return. Is it possible for a minimum volatility portfolio to outperform in the long run?
We would caution any investor to invest in a product like this with the expectation of higher absolute performance. Minimum volatility limits downside risk when markets get rough, but they've been known to underperform when markets rally. The objective is a lower risk equity portfolio. And we view success and a more reasonable expectation for this product as our ability to produce better risk-adjusted returns compared to the broad market.
Thanks, Mike. Janel, can you walk us through some of the key features of the fund, including the team's investment process?
Sure. So we use quantitative models to evaluate stocks in the FTSE Global All Cap Index. The model assesses stock volatility and correlations between securities to construct a portfolio of stocks with lower volatility than the broad market. We apply industry, sector, country, and factor constraints to ensure the fund is well diversified and liquid. Subject to these constraints, the portfolio seeks to achieve the lowest amount of expected volatility. We'll then hedge most of the fund's currency exposure back to the Australian dollar to minimize currency impact on return volatility.
And when would this be suitable for investors?
That's a good question. So the fund may be suitable for risk-averse investors like those approaching retirement who want to maintain their broad equity market exposure but have lower volatility risk. The fund can also be used to complement the core holdings in an investor's portfolio by potentially reducing equity volatility and protecting against the impact of equity market downturns. There's a lower correlation between the minimum volatility factor and other equity factors, so tilting an equity portfolio to a minimum volatility strategy may provide diversification benefits for the investor.
Thank you both for your valuable insights today. Here at Vanguard Investments, we're really excited to have both Mike and Janel join the team and offer you these capabilities in the Australian market. Please contact us if you've got any questions.